What's up, fam? It's your boy, and you already know what time it is, baby. I always like to talk to you about option plays. I love to talk to you about you long-term investing, and I love to talk to you about swing trading, whether that's in options or shares. Now, in today's video, what I want to talk about is the expensive side of what options can look like. And is there any difference between buying smaller option premium contracts than buying at the bigger price ranges that's actually available? We're going to talk about this because now we're seeing that the market makers are actually seeing the market more volatile than normal, so they're raising the price and actually moving the spreads a little bit. So I kind of want to break this down for you, kind of show you how you can actually still make out the same if you're actually utilizing the capital the way that you want to. And I'm gonna give a lot of opinion here. In my opinion, that's going to be a lot of things that I'm going to talk about in this video. So you can make your own determination, but I kind of want to give a little bit of information that I see and kind of give you a little bit of a psychology behind what I actually believe in when it comes to options trading. Now, if there's anything that you have, differences of opinion on, definitely go ahead and leave me comments down below. And if you any more questions that you may even have when it comes to actually options trading, definitely leave those down below as well, because I look forward to reading any and all your questions or even listen to any of your statements that you want to make. Now, if you definitely find value in this, you definitely want to hit that like button, and man, let's get directly into the video. Okay, so let's start over with the SPY, okay? Now, if you are a part of my Discord, you already know that I'm looking forward to seeing SPY hit $500 by January, okay? So I've already started placing that option trading bet that SPY will actually accumulate enough to 500 on the stock price, right? On the share price. So at the end of the day, these contracts started out about 48 cents, 46 cents, around that range when I started purchasing them. And now they have now since made it up to 90 cents per contract. Okay, so let's talk about what a contract is first, okay? Let's just go ahead and go through the semblance of this. So if you're a new investor, you're just not thinking about getting the option trading, I want to make sure I break this down for you. And if you're a savvy option trading investor, stick with me for about 1 minute here. I'm going to explain this really quick and very thoroughly in a 1 minute synopsis, and we're going to move on to where I want to get to, okay? So if you are actually getting into a contract for the first time, we're talking about SPY today, okay? So SPY contracts right now are $500 is what we're looking at. So this is the $500 call that we're looking at, okay? That $500 call for one contract is currently 90 cents for the strike, okay, for the premium. So that premium actually means this, that one contract is 100 shares, because every contract is 100 shares, okay? So you're buying one block of shares of 100 per contract, okay? So if it was times 2 contracts, right, that'd be times 2, that'd be 200 shares, all right? So simple math, okay? So then you'll take that 190 cent times 100 shares, and that will give you a $90 premium, okay, total. So for that entire contract, you will pay $90. And if you was actually going to buy actually two contracts, that'd be 200 shares, which means that this would be $180, okay? That's the math, okay? So now that we got that out of the way, let's go back over. I'm gonna show you that in the option chain actually as well, so that way that you have a vibe for this and you understand where we're going next, okay? So this is about another 15 seconds, so stick with me for just about 15 seconds. So if you're on the Webull desktop, what you would do, you would actually click the ask, okay? This will come up down here. I have it down here. So you'll see that you have a call and you want to buy the call, and if we actually turn this to just one contract, it'll be 90 cents is the limit price, right? You see the estimated value, it hasn't changed yet. You see, the estimated value is $90, okay? That's where that comes from. And if I was to change this to 2, or not to sell, if I was to change this to buy 2, that 2 would turn to $180, okay? So that's where we're at. So that's where all that comes from, right? But what I really want to get down into is, does it really make a difference of when you're actually buying a contract of how expensive it is? Now, relatively, right, I think it does. I want to make sure that I say that clear, that, yeah, relatively, it could make a difference, right? If you don't have the capital or the margin, right, it can make a significant difference in how much you're able to put up. So that's why a lot of people decide that they want to take the less riskier bets by buying lower option out of the money plays. But in my belief, a lot of time you can actually lose your butt on those plays, or it doesn't make a significant difference if you do get into those plays, okay? And the reason why is it's not the break. It's not the break-even price. A lot of times we think about the break-even price as being the reason why we don't want to get into a particular play. But at the same time, you got to think about this. As intrinsic value goes up on a stock, extrinsic value goes up on the option. Extrinsic value is something that is measured, that is actually can invest to make your contract way more expensive than it was previously before, okay? So let's talk about this in the example of AMD, okay? Let's go over to AMD. Let's look at AMD. Like if you was following the Discord, I bought AMD last week. We had about $7 contracts that we bought at that point in time, so about $700 for a couple contracts, and they all ran to about $17. And then I sold off one. I got a couple runners out there, and man, you can find all this information over in my Discord. And if you want to be a part of my Discord, definitely use the first link down below, as you can get in on the plays with me. You'll get every alert for every short trade alert I make, every long trade alert I make, swings, options, shares, all that is available over in my Discord, and you get to be a part of the psychology that I bring to the market each and every week. So let's keep this thing going though, okay? So what we're going to talk about now is AMD. Now AMD currently, let's look and see where I'm at. I think I'm at the 155 call today. Let's look and see. Yeah, I'm in AMD. Nope, I'm in AMD December 17th, 140 call, okay? So let's go down to December 17th, okay? December 17th, go down here, 140 call. You'll see those are currently trading at $9.80. Remember, I bought these at $7 and some change. Now they're actually, I bought them at actually, let's see, $7.30 per contract, okay? So now what we're seeing now right now is on a decline because the overall market is on a decline right now. The NASDAQ is down, the SPY is down, okay? Now, but here's the thing. Let's talk about this in a matter of, I have bought $140 calls, okay? So let's talk about AMD. We got AMD, 140 call, December 17th. Okay, and then the premium at the time when I bought it was $7.30. Okay, so I had 4 contracts, so 4 contracts times 730. Okay, or you can do it this way too if you want to. Okay, so that's 0, that's 12, 28, well 12, 28, 29, right? So 2920 times 100 is actually $2,920 is what I spent on AMD contracts. Okay, now my AMD contracts are still up. I'm still positive on all the three contracts that I have left. But the thing is, I closed out one, so I made a little bit of money already, about $1,700. Now I got $1,200 that actually I need to still cover, but I'm still up nice to where I'm not even worried about it. But let's look at the option chain again, right? The option chain shows that this has declined 35% today. Okay. Now let's talk about that $7.30. Okay. When this $7.30 was increasing in the portfolio, it was rapidly rising to about $17.75. Let's look and see when I closed actual position. I can go over to the Discord. Let's look at the Discord for a second. Give me 1 second. I'll pull it up in the Discord and show you when I close the AMD call. Okay, and you'll see where we at with that. So let me see that real quick. What I want to do is show you that because I want to prove a point to you that I'm trying to drive home today. And you'll see that AMD, let's see. Okay. So this AMD contract right here, no, that's AMD. Okay, so this AMD contract right here, closed this today, right? Can you see that? I want to say you should be able to see that. If you can't, it actually says 17/19/33 is when I closed this contract for, okay? So this is the one of the 140 calls, closed at $17.20. Now, I closed that contract at $17.20. Now, let's talk about that in calculation, right? So if you look at where we at now, right? I bought it for $7.63, okay? Right? $7.63. So $7.30. So let's look at that on the calculator. So you talk about 1720 divided by 730. Okay, that's 235%. So I was actually up 135% on the play. So on that one contract that I closed. Now, here's the thing. What would have been different if I would have bought a further out of the money call, right? Let's just say at that point in time, we can't go back and pass. But let's just say if we was to go down to the $230 call, right? That $230 call on AMD is actually going to be a 34-cent premium, okay? 34-cent premium. Let's say we bought one contract. That one contract is going to cost us 34 bucks. Okay? So now we know that one contract I bought, or these couple contracts I bought, at some point in time went up to about 135% gain, okay? Now, let's look at this in the sense of the 34-cent contract, okay? So I already wrote it out for you. We got $230 call, one contract, $34, okay? So let's multiply that by what 135 would look like, okay? So let's go back over and see what we have here. I already know this is a $34 contract. So let's look and see what that actual will look like. So we was to put in 34 plus 135%, right? Is a 79.90, right? But we divide that by 100, it's only 79 cents, okay? So 79 cents, yeah, it's the same thing. It's going up in value, but that's if the market makers see it going up in that same value. It's a lot of other things that goes into this. So you're actually getting smaller gains, but why are you concentrating your money into one particular lower play and to get what more contracts? So to make the equivalency of that, this is what you would have to do. You would have to go over to the option profit calculator, right? And this is what I want to show you. I want to show you the option profit calculator because I think this is something that a lot of people sleep on at this point. I think a lot of people do not do the math to understand the numbers of what they're actually getting into. So I want to run you through both of these plays into the option profit calculator, okay? And we're going to use the high of AMD for where it actually went to see where it could actually be profitable at, okay? So we'll go down here. We'll actually start with, I'm on the option profit calculator now. So when you go over to the option profit calculator, I'm gonna start on the home page because I have it linked to not the home page. But this is the option profit calculator, right? Optionprofitcalculator.com. You can type this in Google. It comes straight on up. You go to the long call right here, right? And you can actually go right down to where you want to do a symbol at. You put AMD in, and it actually gets the real-time price of the company at that point in time. We are in the December 17th calls. So let's go down to 140. 140 is 980 at this point in time, okay? And like I said, we have 4 contracts, but we bought it for $7.30. Okay, that's $29.20, like we talked about. And let's just put in where it actually went to on the option chain. Okay, so let's go over to AMD. So at the height of AMD got up to 155.45. Okay, on the daily, 155.45. So let's put in that 155.45. Okay, and we're going to use that as the calculation range. Now, so 150, they give me, let's do 140, 155.50 then, since they gave me one down below it. Let's do that. So 155, oh, it goes 155.25. That's what they're going to keep on going to. So on those contracts, okay, when those contracts touched up to these levels, you're looking at about $4 grand, okay, across the spectrum, okay. So if it was to actually go back up to 155.25 like it already touched, you're talking about $4 grand, and it keeps on declining from there, right? This is the option profit calculator. This is how you can actually chart out exactly what you want to. When you usually come into this, it's actually going to have it on maximum percentage of risk, and it's going to give you these numbers, right? It's going to give you these percentages, and then it got the profit in the parentheses. But I like to actually just go to the profit loss, right? I like to know how much money I'm putting up, how much my risk is that I'm actually willing to tolerate and actually go through this. So you can look at this chart any way that you want to. But what I want to get into is I want to talk about the next play. So you see that's $2,900 that we put in, okay? So let's say you still want to spend $2,900 on an AMD play, all right, at that lower cost, right? So we talked about the $230 call. That $230 call right now is at 33 cents. It just went down even 1 more cent, but we'll change it to, no, we'll leave it at 33. It's fine. So let's look how many contracts that we would actually have to buy for that. So we know we'll need more than 10. So we're talking about maybe 100. Okay, so a little bit more, less than 100. So let's go 90. And we did 29.20. So let's go 88, just to be kind of closer to that number. So 89. Yeah, we'll leave it right there. Okay, 29.37. Let's say you bought 89 contracts of AMD, $230 call. You would need for it to, and we're talking about only going to 155.25. Okay, from today's prices. So here's our calculations. Okay. If it don't hit it by November 18th, look how much money you lose. You see that? Look how much money that you actually lose. This is the reason, and the reason why, because the break even is at 230.01. Okay, so let's see how much further you would need this actual play to go out to actually make money on this play. Okay, let's go out to 175. Okay, so now if AMD was to go out to 175 by November 28th, you'll get $3,000. By November 30th, 1,800. If you see it by December 2nd, you'll get $534. Right? So, but look how much loss is after that, though. You need this play to run 22% to make significant gain. Okay, this is what I'm kind of getting at. It's a possibility to YOLO any type of play, right? But you got to be willing to take less profit at a lesser play, right? So if this was to go to 157.50, you would still make good money. But look at the time frame that it actually has on it. But in comparison to actually being in on that 21, we got it over here, right? Let's see. Go back over here to that 17. Let's see. It may be the same one. So look, we go back down here to this option chain of 21 January, and we go back over to that 140 call, right? Did it actually go up? It went up $13 that fast? We had 140 call, right? 140 costs $13.25 now for some odd reason. That's wild. But okay, let's go back down to the 4. And we'll put our price in, and that is $7.30. And you'll see that you have an opportunity to make way more money down here in this realm of 150, 155, or whatever, when you basically was not going to be able to make anything in actual December or in the late November on a longer, riskier play. So you have to understand that you're actually cutting your time off on theta decay by being so further out if the stocks trade sideways. So that's why I kind of want you to understand here. And let's drive this point home a little bit. Let's go over to actual AMD on the chart. Like, look where, let's go out to the daily. Okay, so like I'm gonna take off my actual fib retracement right now. Let's do that real quick. So let's see, take that off. Okay, so what you'll see here is that, yeah, we got this nice point that actually AMD actually ran from, okay, where it actually ran up to this level that it's at currently at this point in time, okay? And it was on a nice further trajectory going up the opposite way before it actually took this breather right here that it's actually taking right now with the market coming down. But the one thing that I want to show you is that it's on this trend line, and now it may even start to consolidate here, making a flag pattern. It's like it's actually at this point where it may actually start to make a flag. Like you got this bullish candle here. So if you're looking at a bullish flag pattern, you have this here, okay? Got this right here, and I'll make it a little bit thicker so you can see it. And then you get this choppiness, right? Like this is the flagpole, then you'll start seeing choppiness going this way. And then for a breakout above actually 153.62. You got to wait through all of that. Now, when you're in one of these longer contracts with lower pricing on the premium, that choppiness can eat away at your contract as you're waiting for an explosion to the upside that you hope gets to a point where you can take dollar value up out of this as a profit. So this is the reason why I like to actually just go ahead and pay the money that actually needs to be paid to actually make the money. Now, I understand that some people do not have the capital to actually be in these higher investment stocks, right? Like, let me give you a couple of examples of that. Like, if you was to go over to Tesla currently at this point in time today, right? Tesla on the option chain at this point, as it's up 3% today, you'll see that Tesla is at 1,056 for the next leg up on Tesla for 1,060 for 17. Let's not even do 17 December. Look at that for 19 November. 1,060 is $51, right? $51 if you actually hit that. Okay, you bring it up here. I don't know why it's always down. Okay, so if you bring that up and you change this down to 1, that 1 is actually $5,000. Okay, I get it. But if you're going to spend similar money anywhere in the market that you're going to have like 4 or 5 different option chains open where it's actually equated to that $5,000, why would you not be centralized in one where you can actually make that same type of money with only concentrate on one option play? Now, I'm only using Tesla as the example. There's other examples out here where they're $20, there's $10, they're $9, and they all range in different prices. But what I'm getting at the end of the day is concentration in one stock and understanding the option chain for one stock and studying that chart as a methodology, understanding it pathologically, understanding the psychology behind how it moves. It gives you better return on profit versus being spread across in so many thin price premium option plays. And that's the type of psychology that I'm trying to get people to understand. Looking at the market, it's fine to have one or two plays out there where you're actually like, okay, I'm gonna play this and see what happens. But concentrating on plays that you actually understand. Being involved in that option chain is going to provide you profit. And it provides you that profit. What you need to do and understand in some way in possibility is that when you're getting that profit, you're sending money to the side to actually play more of that same option chain as it expands in premium pricing, because you're growing profit as it's growing in premium profit. So as you approach expiration dates, you should be closing, understanding how the play is developing, and roll it into a longer play to actually manage your profits and bring in more profit on the same particular play that you have studied and you have grown with over time as well. And play it out and see how much further that it can actually take you. So being a master of one and being a master of none, I'm going to select to be a master of one first and foremost. Look, that's the type of psychology that I bring to the stock market. And I just think about things like this that a lot of people kind of need to address and understand. It's always fine to have a YOLO call and it goes straight up to the moon for you. But a lot of the times that's not going to happen. And the market makers want you to take those lower price premiums and hope that you get caught holding the bag. Simply put, that's how I see it. Now, if you like that type of psychology that I bring, definitely subscribe to the channel. Definitely bang that notification bell so you can be notified each and every time I drop way more hot content like this. And definitely hit that like button if you found value in this type of content that I provided you with today. And comment down below. Let your boy know if there's any stock plays that you see in the options market that are just quite too expensive for your own expensive taste, okay? So that's what I want to know. And at the end of the day, man, if you don't do anything else, check out that second link down below where you can apply for life insurance with Ladder using my link down below. It takes about 5 minutes, and man, it's simply the right thing that you can do for your family and yourself, okay? I'll catch y'all in the next video. Y'all stay safe. Peace.